So in Chapter 15b, we're looking at valuing entities, and now we want to do this from the perspective of shareholders and lenders. And whenever we're doing that, we're talking about the enterprise value of the firm. So first of all, let's remind ourselves what enterprise value means. It's the value of the entity to all stakeholders, which I've been consistently dividing up as D's and E's. And there are several measures of enterprise value. First up, the market's view, what I call Mr. Market, and I got that from Warren Buffett. He calls the market's view Mr. Market's view. And that is the market value of the equity plus the market value of the firm's debt. That's it. That's simple. And for potential investors, there are a couple different methods. What we're going to be focused on is our set of DCF methods. And when we're using DCF methods, the enterprise value of the firm, it's going to be our best estimate of the enterprise value of the firm. And it's going to be simply the present value of every stinking cash flow to and from owners and lenders for the life of our relationship with the firm, starting at t equals 0 and going out for as long as the team is still in control of the firm. And another method, which you may hear a lot on the television as well as other places, is called multiple of Ebitda method. And the way that this works is that if the market's view is on average, that comp's enterprise value is some multiplier like X times Ebitda, then this firm's enterprise value should be equal to X times its Ebitda. So like I said, we're going to be focused on the DCF method, and we're going to compare our best estimate of enterprise value using the DCF method with Mr. Market's view. So using our DCF method, we're going to be interested in, as is often the case, finding the NPV for a project where the team of lenders and shareholders get together to value an entity. So we'll want to know what's the NPV for this team. So in general, the NPV to the team for this potential project is going to be our estimate of the enterprise value using DCF methods present valuing every cash flow minus what we have to pay for the firm at t equals 0, which is really Mr. Market's view, because we're going to have to buy Mr. Market's price for the equity and pay off Mr. Market's value of the principal to be repaid. So we can look at this mathematically as the NPV for everyone, for the whole team, debt and equity team, is equal to minus the price paid to purchase 100 shares of the equity and to pay off all the principal of any debt that's outstanding at the time that we take over the firm. And then we'll refinance the firm however we like. We could say it's going to have no more debt, or we could say it'll be levered at 90%, whatever. That's our choice. And then the second piece here is, again, the present value of every free cash flow that we're going to get from the entity that's available to the team. So here's the free cash flow in year I, and we're going to discount that back by 1 plus our weighted average cost of capital raised to the TI. So we're going to, for each cash flow, first we discount it back to t equals 0, then we add them up, and we compare that to Mr. Market's estimate. And our free cash flows are called unlevered cash flows because they're available to all the financial stakeholders before any interest is paid. And we have a general formula for this here, which is that in any given year I, the free cash flow available to lenders and shareholders is EBIT times 1 minus the tax rate plus depreciation minus change in working capital minus CapEx. And as always, EBIT times 1 minus the tax rate is equal to our net operating profit after tax. So whenever one is talking about NOPAT, they just mean EBIT times 1 minus the tax rate, or this works out mathematically to be EBIT minus tax on EBIT if you just do the algebra on this guy. And that represents the cash and accruals from operations available to owners and lenders. So one little caveat here, I have the star here. We want to remember that this equation only works for our simple accounting cases where depreciation is our only non-cash expense and our only investing cash flow is CapEx, etc., things like that. So just good to remember if you get into more complicated situations, you're going to need a more complicated formula here. And also in our discounting formula, we talked about the opportunity cost of capital, and that, as we know, is 1 minus the tax rate times the pre-tax debt interest rate times the weight of the debt plus the cost of equity capital that comes from CAPM or something better times the weight of equity capital. And that's the appropriate discount factor whenever we're looking at enterprise value. So I'm going to leave you to review all of the terms here if you need to. We've been through them several times before, but I leave them here in case you forget what one of these terms is. You can look it up down here. So we looked at enterprise value specifically for two types of entities. The first was our perpetuity entities. These are firms that are going to operate in steady state infinitely, till the end of time, till hell freezes over. And in these cases, the free cash flow that we're going to get from the firm in any year I is equal to the free cash flow that we're going to get in any other year J, because it's steady state. So the free cash flow it throws out to us every year is going to remain the same forever and ever and ever. And then we can say, well, since this is a perpetuity going on forever, the present value of all these free cash flows stretching out to infinity is just equal to one of those cash flows, remember they're all identical, divided by the appropriate interest rate or discount rate, which is always our weighted average cost of capital when we're talking about values to lenders and owners, when we're talking about enterprise value. So now we can get our NPV for a project like this, which is going to be the present value of every stinking cash flow we're going to get from this firm in the times in the future minus the amount we have to put out, the amount we have to pay at t equals 0 to purchase all the shares and refinance the debt, pay off the original lender and lend the company our new loan, which is what they'll be having to deal with, the company will be having to deal with going forward. Another way we can look at this for our simple case to get the free cash flow in any given year is that it's simply going to be 1 minus the tax rate times EBIT or NOPAT. And again, for a perpetuity, that is because in this case, the working capital is going to be 0 for a perpetuity. Depreciation, the amount of wear of our property, plant, and equipment should be matched perfectly by our CapEx, and there's going to be no weird changes in debt. So the second type of entity that we looked at for enterprise value and getting NPV to shareholders and lenders was what we called purchase, manage, sell, steady state entities, or purchase, manage, sell, steady state projects. So steady state entity is going to mean the same thing it did before. It's an entity operating in steady state, but now we only care about it during the period that the entity is going to be controlled by the debt plus equity team. So it does have to be operating in steady state, but just for the period that we're going to own it, not out until infinity. So that makes this method a more realistic type of method. So now we can get, in this case, all the cash flows needed for enterprise value from this equation. So remember, this is going to be a present value of all the future cash flows available to the lenders and the shareholders. So we're going to take our free cash flow available to lenders and owners in this year I and discount that back by 1 plus the weighted cost of capital raised to the TI. And we're going to do that for every year that we own it. And if it's a steady state firm, all of these free cash flows are going to be the same for every year that we own the firm. So if we own it for 3 years, there's going to be 3 of these terms. If we own it for 5 years, there's going to be 5 of these terms. That's what this summation notation is all about. And quick heads up, if you have not been able to read and understand the summation notation used in this class, it's not too late. Now is the time to make sure you understand it, because I can guarantee you on the final exam, if you don't understand the summation notation, you're going to get at least several questions wrong simply because of that. So learn it, and then you don't have to worry. You'll get at least those 3 questions right, plus all the other questions you were going to get right anyway. Okay, and then our final term for future cash flows that we're going to get out of this as the debt and equity team are what we call SPD plus E. And that's the cash we're going to get when we exit. We're exiting at TN. If we have a 3-year project, N would be 3. So TN would be 3 years. And excuse me, SP is going to be the cash that we get at that time from what? From selling 100% of the shares and from calling in all the outstanding loans, probably just one loan, right? And getting the principal repayment from that. And then we have to discount that back, of course, to T equal 0 by using the 1 plus weighted cost of capital term raised to the number of years until we think we're going to exit. And in this case, again, because it's a steady state firm, our free cash flow available to lenders and owners in any year I is going to be the same in all years, and it's going to be just NOPAT. And again, that's because we're assuming that this is a steady state firm for the time we own it. So now we can put everything together and get our NPV equation for evaluating projects like this. So remember, what's the NPV? The NPV is the present value of every stinking cash flow associated with a project for the project participants, which in this case is the set of lenders and shareholders, starting at T equals 0 and going out to the end of our participation in the project. So starting at T equals 0, what happens? Well, we've got to buy at market price 100% of the shares of stock, and we've got to pay off the existing debt because the current lender has a change of control put. We assume that that put is exercised, and that put means that if there's a change in control, all the current debt is due and outstanding to be repaid at that moment. So that's what we have at T equals 0. And then we get, for as long as we operate the firm, we get the free cash flows from operating the firm, which is just going to be NOPAT for us. And we have to discount each one of these back, get the cash flow, discount it back, do that for all of them, then add them up, right? And then finally, our last term is the pile of money that the team gets, the lenders and the equity holders, for selling the shares some years out in the future. Hopefully, we're going to sell the shares for more than we paid for them at T equals 0, plus the proceeds coming in from the debt folks in the team exercising their change of control put. So when someone else buys the firm, we say, okay, hurrah for you, but we are going to make all of the principal on any outstanding debt due and payable at the time of transfer of the firm. So in words, what we have for the NPV here is we have minus the purchase price, D plus E, so minus the price of getting 100% of the shares and paying off the existing debt, plus our estimate of enterprise value. And that's it for chapter 15b. Those are the 2 types of problems we were doing, and always with the types of problems that we were doing in the simplified assumptions that we were making, this FCF D plus E always turned into NOPAT, and NOPAT was a constant because we always used the assumption the firm was in steady state for as long as we owned it. Okay, so that wraps it up for this chapter, and I'll look forward to catching up with you again in the next one.